Good afternoon, ladies and gentlemen. My name is Michael Camo, and I am an editor and columnist from Minyanville.com. Today, I'm going to be speaking with Michael Gayed, who is one of Minyanville's most popular contributors. Mr. Gayed serves as Chief Investment Strategist for Pension Partners, a New York-based asset management firm. And how are you today, sir?
I'm good. How are you?
I'm doing great. So we're going to kick it off with a big question I feel like a lot of people don't answer. And what makes stocks, I guess, as measured by the S&P 500, go up and down?
Well, largely it's obviously emotions, right? So in some ways the stock market is no different than somebody who has bipolar disorder, goes through periods of manic movements up or depressive movements down, and when people are making money, that tends to make people take on more risk, tends to cause other people who have been not participating in an up move continue to play the up move, which in turn forces more money into stocks, and so on and so forth. Now, the question becomes, well, under what conditions does that start, or under what conditions do equities tend to do well? And it's generally when you have that, bipolar type of mentality happen because of an expectation of inflation coming down the pipeline. So in other words, as inflation expectations rise, that is historically the kind of environment that encourages people to take risk, encourages markets to eventually get into some kind of a extreme manic phase. Now, the other side of that is when you have inflation expectations falling, or you have a growing fear of deflation coming, that's when you tend to see much more depressive states. That's when you see money start to leave equities in favor of fixed income. So, the long and short answer of it is what drives markets, it's emotions, and then what drives emotions is ultimately inflation or deflation expectations.
Okay, then we're going to get to the second big question is, how do you know this?
So we've done a number of different studies on this. We actually have two white papers that, while not directly focused on inflation expectations per se, are focused on things that react off of inflation expectations. Those should be coming out shortly, two competitions that we're just waiting on to see if we've won. But this is based on actual testing of market relationships, looking at under the, what are the conditions that volatility tends to rise. It's when you have these deflationary pulses historically. Now, you've had, obviously, in the last, we'll call it, 12, 18 months, a desyncing of that relationship. You've had disinflationary pressures across the globe, in the developed markets especially, and yet you've had stocks rise, countering the concept that inflation expectations drive equities. Been a bit of an outlier juncture from that perspective, but the longer-term cause and effect is unequivocally there when you look at the data.
Okay, now I know you do a lot of work in sectors, and now is there anything specific that jumps out to you as interesting right now?
Yeah, I think energy actually, among almost all of the S&P sectors, probably is the most interesting. Oil has obviously held around this 90 to 100-ish range for some time, despite this energy revolution in the United States. And in general, that's been a very unloved area of the stock market, underperformed fairly substantially, really since the mid-08 level where oil spiked to, I think, 147. The energy stock side have not really moved in terms of outperforming at all. So looking out into, from a sector level, I myself prefer those areas which most people are underweight, because you can bet on make a contrarian trade and make a bet that there's going to be some kind of leadership coming. When you look at broader commodities, you look at the materials sector, there does seem to be some signs of life beginning to show. There is this, notion out there that the super cycle of commodities, which is this idea that China drives the marginal price of any commodity because it's such a big buyer of them, that the super cycle is over because China is moving away from investment more towards consumption. But just because the super cycle is over, which obviously impacts oil and energy and materials and commodities overall, there are still cycles. And the cycle for energy probably is coming sooner rather than later.
Okay, what are you seeing in retail? Because retail had a pretty bad start to the year. With Polar Vortex, earnings news was terrible pretty much across the board. The holiday season was a disappointment, but then, RTH, I guess specifically, fell about 10% off its highs, and then it screamed back up in February. Is there anything there?
Retail I think it's a difficult sector, or industry rather, within the discretionary sector to try and get right at this point. Keep in mind it's been a very old leader at this point. It's outperformed the broader stock market since before the March 2009 low. So you're talking about a number of years where it's been unrelentingly the place to be. At some point, that does reverse. I mean, leaders do turn to laggards. There is a duration aspect to all sector and industry movements. So, it's had a rough start to the year, and I think, the market, again, as it kind of shot back up, gave the benefit of the doubt to the consumer story again. But realistically, if you're going to believe that there's another cycle coming in commodities, then the consumer might have a bit of a hard time. So in other words, the thesis about energy as a sector and materials and commodities coming back should come at the expense, at least theoretically, of the retail industry and consumer stocks overall.
Okay, how about housing? Housing has done, well, the ITB is up 6.5% year to date, and the S&P is flat. Now, do you think that's sustainable?
It's not clear. It is impressive that I think housing stocks, home builder stocks, anything kind of tied to that, have done well in the face of at least some of the more recent data, which has been on the softer side, even though we saw a good increase in housing starts data-wise. But it is impressive that the stock side has been holding. But when I look at it relative to the S&P, it's been kind of in a broad range. In other words, it's outperformed, underperformed, outperformed, underperformed. Nothing really substantial. I do think that housing overall is key to the reflation story. So you want to see housing stocks lead if you're really going to believe in a continuation of this bull market on equities. But as far as where to position, I still think that the housing story, while there's a comeback, is not as compelling as looking at those areas which simply have not participated at all, which again goes back to the commodity, emerging market, and energy space. Okay,
so what's your outlook for 2014, at least for stocks, based on what you're seeing now?
The traditional, it seems like the key average sentiment, so to speak, is that you're going to see a continuation of stocks rising, but it's obviously not going to be to the extent of last year, 2013, which was very much an outlier. Now, if inflation expectations rise, that's going to be supportive of equities overall, and probably does continue to push money out of bonds, from a big picture perspective into stocks. But the area which will most benefit from rising inflation expectations is probably going to be anything outside the United States. So it means that for the year, you probably could see U.S. stocks, up in their more traditional 7 to 10% range. But if that's the case, then you could see emerging markets up, some north of 30. Simply because if you have inflation expectations rise, then you remove this narrative of deflationary pressures and an end of this concept that buyers don't drive supplier demand, so to speak. So in other words, U.S. markets buying from China, Brazil, Russia, India, that if inflation expectations rise, that means the economy is getting better. That means that we're going to be buying more from those exporters. So you could see a substantial move in the emerging economies if you get that kind of condition. If you don't, though, I think you do have a real dilemma that has to be resolved, which is that U.S. stocks have divorced themselves completely from reflation. This anomaly last year of this disconnect does have to get resolved by either inflation expectations rising or U.S. stocks falling. The best case scenario is inflation expectations rise and pull emerging markets with them. The worst case is that they don't rise, deflationary pressures come back, the market begins questioning the Fed's efficacy overall, and that causes U.S. stocks to break as this Fed put concept erodes. It's not clear. I think the most likely scenario will likely be inflation expectations rising, but it is a risky juncture because after all these trillions, you still haven't seen any kind of pickup in inflation.
Okay, so when you think about things like inflation expectations, are you looking for signs in intermarket relationships or underlying economic fundamentals in terms of at least measuring the crowd for where you want to move? Sure,
that's a great question. So, there's a lot of people will measure inflation expectations based on break-even spreads between, Treasury inflation-protected securities and, the yield that they have and nominal Treasuries. The way we define it is more by demand for those things which are sensitive to inflation. So, based on these intermarket movements. So, for example, when you have a period of rising inflation expectations, you tend to have commodities rise. People want commodities as an inflation hedge because they're anticipating inflation coming down the pipeline. Conversely, if people are anticipating deflationary pressures, you tend to see sectors like utilities, consumer staples, and healthcare outperform and do better than the broader stock market. And that's because with deflation or deflationary pressures comes less demand for cyclical areas, more demand for non-cyclical areas, right? So it's very much based on price movement rather than break-even spreads. Right now, there has been a bit of a pickup in demand for those items which are hedged to inflation. But every time we've seen this in the past year, year and a half, that's fallen off. And U.S. stocks have, not cared just yet. But I will ask everybody who's listening to this, to ask themselves, why is it after all these trillions, why is it despite Fed tapering, are we seeing yields fall? Are we seeing yields not rise above the 3% level on the 10-year? Well, presumably that's because there's still some other bigger deflationary pressure bearing down on the financial market.
Now, do you think that deflation has become a popular topic of discussion? I mean, people probably talk about deflation as much as today as we talked about inflation in, say 04 to 07. Do you think that kind of hyper-awareness, is a sign that maybe fears are overblown? I mean, I know we've seen at least one magazine cover mentioning deflation, but yeah, I mean, do you think deflation fears are overblown or warranted?
Well, I mean, I think the answer to that is to ask the Japanese, right? In the sense that I think there was a growing concern of deflation after the 1989 top in the Nikkei, and those fears were validated. And in some ways, there's this old quote that what one believes to be true is either true or becomes true. So if everyone is believing in deflation, what does that mean? It causes people to then hold off on purchasing something now because they believe deflationary pressures will make items less expensive or less costly in the future. So if everyone does it at the same time, that of course creates a reinforcing deflationary cycle. It is unusual to consider that we may not be re-entering an inflationary period, given that inflation has been always the most talked about topic for decades. It's almost a very sensitive area for a lot of individuals in America, obviously. But we do have to ask ourselves, even though people are talking about it, what's going to reverse it? If it's a function of psychology, and the Fed has done everything it could, what's going to cause inflation? What's going to break this deflationary spiral or this disinflationary spiral? It may end up being the commodity side pushing prices higher. But again, the super cycle is largely over. So it's not clear. I think we're in very uncharted territories, but I think that also does mean that buy and hold, while it seems like it's working now, is probably suspect going forward. You are not supposed to, environments that are consistently deflationary are not favorable environments for stocks. If you don't believe me, ask Abe in Japan. So we have to get out of this deflationary period to really hold on to some of these gains that have occurred in equities.
Okay, so I guess as you're looking forward, how can the average person, I guess, look at the market and see inflationary or deflationary pressures?
Yeah, I mean, the way to do it is to track actual market prices rather than tracking CPI data. It's to actually look at what sectors of the stock market are leading or lagging, what asset classes are behaving off of. Does it make sense that treasuries are falling in yield despite the Fed tapering, and with everybody thinking that it's inflation, maybe it's still deflation? Does it make sense to see gold doing as well as it has this year when there's a feeling that the Fed's not going to be stimulating anymore? Is gold actually anticipating maybe a deflationary juncture? So I think you have to kind of step back and look at the way market prices are acting relative to each other, and ask yourself, is there some kind of consistent theme or message the market is giving? Last year, that theme was unequivocally deflation, disinflation. If you were an investor in gold, emerging markets, and commodities, and in tips, that was the right message, and you would have avoided some heartache losses. If you just looked at the U.S. stock market, you'd say, well, that doesn't matter. But it does matter. It matters over time, not over a single, period of outlier movement. And I think the question this year is going to be, are you going to see a resync of that? The way to track that is by looking at price movement. If this is real, you should see the global cyclical sectors lead. If this is real, you should see emerging markets come back. If this is real, you should see commodities strengthen. If none of those happen, then I think you have to be very cautious with where U.S. equities are.
Okay, so let's turn it around. what could ignite a real bull market?
Well, I mean, I think it may end up being this sudden realization that the negative narrative is wrong in emerging markets. You know, the thing that I think has held back a lot of real aggressive risk taking on the global landscape has been this feeling of a crisis in the emerging economies in Brazil, Russia, India, and China. And while there's this strange belief that if you have a crisis in emerging economies that the U.S. is not going to feel it, while that is out there, if you remove this narrative of a crisis, you probably are going to see what could be a true from here after breaking new highs multi-year period of strength for equities and alongside that rising inflation expectations. The big fear everyone always has is another 2008 repeat. It is still relatively fresh in people's minds. There's this notion out there that that's going to come from the emerging markets. If it doesn't, and if indeed the emerging economies have priced in much more pessimism than is warranted, then the pricing out of that pessimism is ultimately bullish for overall equities. It can be bullish for U.S. equities, it can be bullish for Europe equities, it can be bullish for Japan equities. It'll be far more bullish for emerging markets.
Now, okay, speaking of emerging markets, do you think that part of the slump could be just from them having, I mean, they went up, I guess, they more than doubled off the 2009 bottom by early 2011. Do you think things maybe just got overheated, at least in terms of the prices, and now, things are getting consolidated, basically?
Yeah, but if they overheated on that level, then they've also underheated, I guess is the right way to say it, now, right? So when you look at price to book, you look at price to earnings. I mean, these countries are cheap. I mean, it seems unusual to me that everybody wants to be an investor, but nobody wants to actually invest in that which is cheap. Everybody wants to invest in that which is going up and to the right. Everyone is ultimately trading yesterday. So while yes, you can argue that they may have overshot to begin with, I would argue that they've underperformed for so long that they are due for some kind of period of leadership, and that this narrative simply is not backed up by the facts on the ground. Everyone is comparing this to 1998. 1998, you actually had a crisis. You should probably do the comparison to 1999 when emerging markets were up something like 60%. Because of a pricing out of the 98 crisis. You could see a pretty substantial outperformance move. And I've been on this theme for a while, and it hasn't come to fruition yet in our mutual fund and our separate accounts. Every time we've gone into it, the momentum reversed, and then we effectively rotated out. But there is a big move coming. The when to buy and when to sell is always the issue. But if you are an investor and you're saying to yourself, okay, where do I want to invest and not look at that investment for 5, 10 years, they have much better demographics, they're in much stronger shape, and no matter how much you may question China's data, they are still growing faster than the United States and faster than Europe. At some point, everything bad under the sun is priced in. And as investors, you have to ask yourself, are you buying something that's worth 95 cents, and that's 95 cents and worth $1, or are you buying something that's 50 cents and worth $1? I think when you talk about emerging economies, you really talk about the latter, especially given how bad the sentiment is. There is this, in betting, right? You have if everyone sees a payout, and a lot of people are betting on the payout gets split among a lot of different people. So you don't really make a lot of money if everyone believes in something, because you're splitting that belief among so many other people. The whole idea of contrarian investing is that because so few people are betting on a certain pot, that if you are one of the few that actually is betting on the pot, that you're going to get pretty much the whole thing. And I think that's very applicable to what's going on in the emerging markets overall, simply because when you look at sentiment surveys, when you look at weightings, nobody's betting on them. Nobody wants to make the long case. Nobody wants to make the value case. Nobody wants to touch them. That's probably exactly why you should consider them.
Now, do you think investors are maybe too eager to embrace these negative narratives? I mean, and I don't know if this is a function of the media, because we've seen things, the Euro debt crisis, sequestration, Syria, Greece, Cyprus, the list goes on and on of these, these big fears that, at least in recent history, they've kind of ended up as not very meaningful, at least for our markets.
Sure.
Do you think people kind of cling to the idea that things are about to topple over? Do you think that's just, and maybe that's 2007 and 2000 in people's minds, but do you think people are a little bit too eager to expect bad news these days?
Yeah, I think the bear case always sounds like the smarter case. almost universally, whenever you hear somebody who sounds intellectual, they tend to be much more negative than positive, and the mind kind of gravitates towards that. So I do think there's an element of acceptance of any kind of a negative case and belief in that negative case, rather than trying to counter it. And all that also has to do with just psychology and the way the mind acts. You tend to have people. You don't tend to have stories which are have happy endings. You tend to have stories that in the theater which are the end of the world type things. That's when you tend to see a lot of people watching a movie, right? So it's the negative is always what draws people, and the belief in the negative is always what draws people. That creates, of course, a self-fulfilling negative prophecy, because if everyone believes in the negative story, they start to act on the negative story. They start selling the emerging markets. But at some point, that does change. Every trend has a reversal. That reversal, we don't know exactly when it is, but we know that every day that goes by that the trend has been, the way it's been, you're getting closer to the end of it. And regardless of that attraction to the negative narrative, that negative narrative was as strong now as it was for U.S. stocks in 2012, was as strong now for emerging markets as it was in March 6, 2009. You actually want to buy negativity, and that's when you tend to make the most money.
Okay, excellent. So I will end with one last question. And I notice on Twitter you can follow Michael at Pension Partners. You post a lot of links to like life hacker and sort of self-improvement things. So, give our audience one thing they can do to be a better investor, something they can put into practice right now.
I think, look, it's important to filter out the signal and the noise, to kind of steal a phrase from the book on that, the signal and the noise. We are inundated with information daily, and there is this belief that because we have so much information that it means that we can make better decisions. That's not true. In many ways, more information actually debilitates decision making. If you're talking about investing and trading, ultimately you want to focus on those areas which make the most sense from a backtesting perspective, from a cause and effect perspective, and really filter out a lot of the noise that comes from the news and the financial media, because at the end of the day, if you're constantly reacting rather than being proactive in your positioning, you're going to be losing money over the long haul, and there are plenty of studies that show that. So I think it's just, know thyself and know what you're hearing may not actually, be good for your portfolio. Stick to a plan, and at the end of the day, be patient. Patience does pay.
Well said. Michael, thank you very much. We always appreciate your contributions, and have a great day.
Thank you. You too.